is Bazaar Morning Call, live from the CNBC TV 18 headquarters in Mumbai.
What happened in the last few months was a correction, a break in the bull market, rather than an ending of the bull market. So I remain optimistic about the year ahead.
At this moment, I would think that the market's going to be more calibrated. 10.7 is a short-term resistance for a market.
The worst of the liquidity issues are behind us. Whether there would be no problems, I don't think so. Whether there would be problems, yes.
Good morning. Welcome to Bazaar Morning Call. I'm Lata, with me Anuj and Sonia, and all of us once again wishing all of you a very happy Diwali and a very happy Samvat 2075. Hi, both of you.
Hi, once again, right? I mean,
Yes.
we were here on Diwali Day as well. But how is the market setup looking? We had a great Samvat. After many years, actually, we ended in the green. You think it's the start of things to come?
Well, I think it was clearly fueled by crude. I mean, we had crude at 71 on Samvat Day, on New Year's Day, and today it's even done better than that. So the fueling hopefully will continue. Just a word on the US Fed. I think there was both a positive and a negative, so it may not be a very big trigger for any market today. On the one hand, they said that the economy is strong, and on the other, they said fixed income is dipping. So we can leave that aside. For us, the crude market and its ebbs and flows are much more important. Crude officially entered bear territory because it's 20% down from the October highs of $86 to 70.6 thereabouts that it fell. But we must remember that while this is a cause for celebration for India because it's such a big headache on the balance of payments front, it also means that global growth, there is a huge supply issue. The OPEC countries and the non-OPEC countries are producing record, and the expected absence of Iranian oil has not come by. So this is really a supply-fueled fall in prices, but there is some indications of a fall in demand as well. Moody's in particular has actually cut the demand forecast. So, the table will come up for you. The way we were when crude was at 70 last time around on August 17th, I think. This is a very helpful table that Mangalam has drawn up for us. At that time, we were at 11,500. But will we be able to repeat that feat? Meeting stuff, because things have changed otherwise. This fall is coming on the back of a slight worry about global growth. But more importantly, it's also coming when our debt market troubles are not quite over. And we have election overhang as well. NBFCs are not the force they were. So, this is all pre-IL&FS actually. So we may not be able to repeat quite this feat, but there's no taking away from the fact it's positive for us.
Okay, it's positive for us. The SGX Nifty for now is indicating a bit of a soft start. Let's see which way that goes. It's in the red. Some of the Asian markets are also trading in the red this morning. But Anuj, morning, what's the sense you're getting about how the start of the new Samvat would be?
Morning, Sonia. Should be quite okay, but let's see. The market has not shown any signs that it wants to end the pullback, and the market will give you signals. For now, it hasn't done that. But your risk reward, is it favorable to take a fresh aggressive long right now? Perhaps not. That was at around 10,000, 10,100. But right now, the market's corrections are very shallow, and the moves on the upside are very big. That way, the one step back, two step forward process is on. And the market is very light. I haven't seen any kind of positions added. I'm just looking at the futures and options data. There's hardly any positions on the long side for this market. So that way, this market does not have the weight of carrying too many long positions. If at all, it's a market which is still heavily net short. So that way, there's perhaps a good chance of some more short covering.
It'll have the headroom to add more weight.
Exactly. And of course, crude remains the biggest positive factor. Just like it was the biggest negative factor on the way up, it's the biggest positive factor on the way down. The only issue right now is if you're entering now, you're entering very close to 200-day moving average, both on the Nifty and on Bank Nifty. Nifty is at 10,750. That Bank Nifty is 26,050. So about 300 points from here on the Bank Nifty and about 150 points from here on the Nifty. And normally, just like on the way down, the first test of 200 DMA is defended. Perhaps on the way up as well, the first test of 200 DMA would be seen, with some kind of resistance. Having said all of that, the point that we've been making for the last many days now, you have to assume that this market's made some kind of base at 10,000, and you have to add good quality stocks to your portfolio. And because everyone is so scared about mid caps, that's the space which actually has quietly outperformed over the last 1 month, may continue to do so, especially the quality mid caps. And portfolio building, I think, still remains the key word if you're looking at the overall, say, Nifty 500 or the broader market. That still remains the key right now.
Well, I just want to add a couple of things. First of all, the valuation scare is very much there in people's minds. And even at current levels, unless we see the proof of earnings to once again take it to 21 times like we did in August, will create a little bit of a flutter. And more importantly, we have to look at the positive side in terms of how global trends will move. I mean, do you remember the day last week when we had a positive FII number? That was the day when crude seminally fell from 75 to 72. Yeah. And now it's fallen to 71. Yesterday we had, even in that minute somewhat hour trading, we had a positive FII number. So there is a global algo trade which hedge funds appear to be playing. I mean, I'm not privy to anything. That when crude falls, similarly India becomes a buy. I just want to see if some of that will fuel us today. Actually, some of that has played out already, right? I mean, in the first 10 days of November itself, the MSCI Emerging Market Index is up almost 4%. And, MSCI India as well is up about 3.5%. So I guess it's the crude effect, the fall in crude, that's playing out in our own markets as well. But let's take a look at what our wise experts have to say as we head into trade this morning. Rhythm Desai of Morgan Stanley says the Q2 FY19 season has seen a steady revenue growth, but softness in profit growth driven by margin compression. But this was not a negative surprise. He says the earnings beat ratio was 49%, and Sensex companies' revenue and net profit growth at 15% and 0% year-on-year is in line, and a 9% beat respectively. Rhythm says since the start of the earnings season, consensus has revised down the Sensex earnings growth by 261 basis points for FY19 to 17.6%, but revised it up for FY20 by 115 basis points to 24.3% year-on-year. That looks like action replay for the fourth time, where you revise down the current year and revise up the next year. But let's see if we can get 17.6. Money market views. This one comes from Bhaskar Panda of HDFC Bank. He says the currency markets will open after holidays and 2 days of normal flows would hit the market. He adds global oil prices have remained subdued. Expects the USD INR pair to trade below the 73 mark today and see a range of 72.70, 72.95 for the day. And he also speaks about the bond market. He says a stable rupee and benign crude will help Indian benchmark yields. He expects a 10-year benchmark bond yield to trade in a range of 7.75 to 7.8% today.
Okay, of course, crude remains the biggest positive factor for Indian market, but here are the other global cues. Here's Nigel with the world view.
Well, the US markets ended more or less flattish with a bit of a negative bias. The Dow is on a 4-session winning streak. The S&P, in fact, that snapped a 3-session winning streak. We had a couple of cues that are coming out of there. One eye was really on the Fed Reserve meeting that was likely to, give some kind of commentary. They didn't change interest rates, but they said that, in fact, they expect further gradual rise in overnight rates. So that was some commentary that came in there. In terms of stocks, well, Qualcomm was one stock that was down close to around 7-8% odd. The guidance that they gave was lower than what the street was estimating. They were talking about lower demand coming in from China. So that's about the US markets, with shifting focus to the European markets. In yesterday's trading session here, the FTSE, that was a relative outperformer, ended with the gain. Otherwise, both the other two markets didn't look too good. The European Commission said they expect growth to slow down in the next couple of years or stall in the coming years. So that wasn't a great piece of news that came out. And even the German economic data that came out of there, the amount of surpluses that fell, the trade surplus did see a bit of a contraction. Result reactions continue to be good. Banking numbers look good. Commerce Bank came out with a set of numbers. Both those two stocks were up between 3 to around 4% approximately. But the Asian markets, they're trading in the red today. However, from an India point of view, crude oil prices have moved to $70 per barrel. That'll be a positive. And the dollar index is steady at around 96.5 odd. SGX Nifty, though, for starters, is indicating a 20-point downtick. Thank you very much, Nigel, for giving us all that we need to know about the world outside before we start trading. But to help us parse the Fed statement, the fall in crude prices, and whether all this makes India a buy, we have Mark Matthews of Bank Julius Baer
and Jeff Lewis of Manu Asset Life Management. Gentlemen, good morning and thank you very much for joining us. We have just put behind 2 festive holidays and are trying to get a reality check, actually. Mark, well, first to you. Will this seminal fall in crude prices make India an attractive market? Or are these harbingers of lower global growth?
You know, I'm sorry, I didn't quite catch the question.
Well, the fall in oil prices...
You'll have to repeat it, I apologize.
No, never
fall in
mind.
oil prices.
Well, the fall in oil prices, will that make India a buy? Will it be very positive for us? Or will you see this as part of a global growth slowdown?
Oh, I understand. Thank you. Well, the fall in fall in oil prices was partly due to the fact that global growth has decelerated. You're right, and I don't think that really impacts India in any material way. In fact, it makes India look a bit better because India is basically a domestic consumption story. But you also had as factors behind that fall in the oil price the reimposition of sanctions on Iran and the Khashoggi affair in Turkey. And those events, I actually think, are kind of receding behind us, and the oil price had priced it in, and we're moving along. There's still a lot of shale coming out. So our forecast is for oil to actually be marginally higher than it is now 12 months from now.
Oh, okay. Forecast oil to be higher. Jeff Lewis of Manulife Asset Management also joins into our conversation. Jeff, hi, good morning. One of the statements made by the Fed Reserve was that the growth of business investments has moderated from the rapid pace that we've seen earlier in the year. How would equities react to this slowdown in growth if it plays through over the next 6 to 12 months?
Well, I think we've seen the U.S. economy growing at a rate which would be unsustainable if it continued at 4%. So we're of the view that a gradual slowdown back towards trend is actually what markets will want to see, and which could be one of the things which will cause the Fed to maybe move at a slower pace in 2009. We're really looking for no more than 2 more rate hikes. So this would be a favorable scenario, I think, if U.S. growth is coming down from these 4% levels, which are much higher than the long-run sustainable rate, and coming down closer to trend. So we would be very comfortable with that.
Okay. Mark, hi, good morning. The other issue that an Indian market will have to deal with starting now is the big state elections, and we just had result from some by-elections which were not really good for the ruling party. In that sense, is there a risk that just in the near term the Indian market underperforms a bit?
I do think that most foreigners will probably want to wait and see what happens with the general elections next April. I think that's true. And there's a broad feeling that although the BJP will come back into power, perhaps it will have to cobble together a coalition in order to do so, and that could dilute reform. But I'm a little torn as to what to think about politics, because on the one hand, I do feel that demonetization really hurt the BJP standing with the business community, and it has yet to recover from that. But on the other hand, when you go to India, it seems like most people that I speak to, at least, still very happy with the reforms that, broadly speaking, the reforms that have happened since the Prime Minister came into power. And so, yeah, we'll just have to wait and see. I think that's the approach that most foreign investors will adopt.
Okay. Mark, the other point that we were discussing over the past week has been that the gap between DM valuations and EM valuations are at a historic now, the difference. So do you think that there is a case for smart money once again looking at EM markets as an attractive destination?
I absolutely do. Of course, the asset class is very broad, so one needs to be specific. But particularly in currencies, the real effective exchange rate of the emerging markets is pretty much back down to historic lows, and they have bigger value now even than at the absolute bottom of the Asian crisis 20 years ago. So I think so, and the pocket that I would be more interested in is probably the bond market rather than the stock market, because I think that the spread is wide enough there now that you're getting more than compensated from the risk you're taking. Some of the emerging markets are still in very low growth trajectories, so it might be premature to buy their stock markets. But it looks like the ones that really got hurt the most, which were Turkey, Argentina, South Africa, they put in a floor well over a month ago, and they're up substantially from then. So short answer is yes, I agree.
Okay, Jeff, what about you? The MSCI Emerging Market Index is attempting a bit of a recovery. In fact, this month it's up about 4% odd. Would you look to put fresh money to work in the emerging markets? And within that, where does India feature?
Yes, I think we would. I think this is a good entry point for longer-term investors. We've had a situation where the U.S. economy has performed very well, but it hasn't been reflected in the stock market. When that tends to happen, then you tend to get a strong rebound in stock prices, and I think that will set the direction for risk appetite for emerging markets in 2019. So this is not the time to be selling. This is the time to be buying. And I think within that, India still doesn't look too cheap, but it's got one of the better long-term growth stories. So it's also a market that we're very comfortable with. And I think some of India's problems this year on the macro side were exaggerated by the markets. And I think with oil prices coming back now, trade deficit improving a bit, inflation looking okay, then India looks set fair.
Okay, are you buying now, Jeff Lewis, and anything in particular? In India, I mean.
Well, I think that's something which our India equity managers would answer rather than myself.
Oh, right. Okay, Mark, Matthew, what about you? What's the view at Julius Baer Investments? Are they looking at India and any specific stocks or sectors?
Well, I'm usually an India bull, but we have become a little less sanguine on it recently. And the 3 points I would make are, first, the NBFCs, I think, are still an outstanding risk because they were responsible for almost 30% of new loans over the last 3 years. And the total credit of the NBFCs is big. It's about equivalent to a third of the bank credit outstanding. And the second point I would make is that the earnings haven't been very decent in the most recent quarter. I think there have been 36% of the MSCI India companies that have reported so far that have beat, but 42 have missed. And the fact is that other emerging markets have dropped more than India. So in relative terms, it's actually become more expensive. So I think we've always liked India long term, but my feeling is that there are better alternatives in the asset class right now.
Okay, that view is very well taken. We've heard that actually a couple of times in the past as well. Thank you, Jeff and Mark, for joining us and giving us your take on the global markets and, of course, the impact it would have on India. We'll take a quick break on that note, but on the other side of the break, plenty of stocks to talk about. Our list of top 10 stocks lined up in just moments from now. Stay with us.